Hey, it's John King, and it is Friday, the 11th of March, and I want to give you my weekly market update. So it has been a wild ride this week. If we look at the interest rate markets, last week, the 4th on Tuesday, was the best rate we'd had in about the last 3 weeks. That obviously had a lot to do with the news of what was going on in Ukraine. The stock market was having major reactions to what's happening in Ukraine, and last week we saw rates improve on Monday, Tuesday. They got worse on Wednesday, and then they came back a little bit on Thursday and Friday. And my last update last week, I said we were going to see a lot of volatility, and we're continuing to see that. This week, every day has been worse than the day before. So we are at the worst rates that we've had pretty much so far this year. And that's leading up to next week and the Federal Reserve's meeting that will be on Tuesday the 15th and Wednesday the 16th. And on Wednesday, they're going to be announcing whether they are going to be increasing short-term interest rates. Now, last week I talked a lot about this on my update, and I said that short-term interest rates don't drive long-term rates. And I actually had a debate with somebody on YouTube saying that I was crazy and that they are related to each other. And I'm going to repeat again, I don't believe that there is a direct correlation. The Federal Reserve controls rates that banks borrow money from them overnight. That is the only interest rate the Federal Reserve controls. What you'll see if you know anything about the bond market or you pay any attention is that you've got bonds that last for a year. And that means that a bond is simply money that you bought. You paid the federal government investing in a bond. The government issues bonds in order to pay for things like roads and improvements and stuff like that. And if you buy a bond, you're basically saying, hey, I'm going to give you, the government, this money, and you're going to give it back to me in this amount of time. So there's 1-year bonds, 2-year bonds, 5 and 10-year bonds, and you're deciding how long are you going to keep my money before you pay me back the principal and all of the interest. The short-term bonds, the quicker you're going to get your money back, the less interest you get paid by the government. If you say, hey, you can keep my money for 30 years, well, you're going to want to collect a lot of money over that 30-year time frame because you're not going to be able to get your money back from that bond. Now you can sell that bond. You can say, hey, I owned this money, I loaned the government money, and they're going to pay it back to me in 30 years. Does anybody want to buy the rights of the government paying this back to me in 30 years from me? And that's how bonds trade from one person to another. And that's where the value of a bond goes up and down. So here's what's going on. The shorter term, the quicker that the bonds are going to be paid back to you, the lower the interest rate should be. The longer term, the longer it takes, the higher the rate should be. That gap is decreasing. In other words, short-term rates are going up faster than long-term rates are going up. And that's because the federal government controls short-term borrowing of money. The federal government, even though they're loaning money for treasury bonds, they don't control the rate that those bonds are paying. The market appetite, the willingness of people to buy those bonds controls the interest rate. This is a lot deeper than I typically go. I'm still trying to stay at kind of a high level so that this makes sense. The federal government next week will raise interest rates on overnight loans that banks use to borrow money from the government. Banks use that rate to decide what the interest rate is going to be on things like your credit card. Things like your adjustable rate mortgage, those are often tied to the prime rates, but long-term mortgage rates are not tied to the prime rate. Mortgage rates have been going up because of inflation. The federal government is raising the short-term rates to slow spending, to slow businesses from the access to cheap money. And therefore, the goal is if they make it more expensive for you to borrow money on your credit card, you're not going to spend as much money on your credit card. And if you stop spending money on your credit card, then inflation will slow down because the demand for people to buy things is what's causing inflation to go up, plus the lack of supply or the lack of things to buy. So 2 things cause inflation: demand going up because more people want to buy stuff, and supply going down. In other words, there's fewer things to buy and more people wanting to buy them. All of that said, the federal government is raising rates starting next week, or we expect them to, in order to stop inflation. Because if it costs you more money to borrow on your credit card, you're not going to spend as much money, which means that the demand of people wanting to buy things should slow down. The question mark is what's going to happen on the supply side. Are we going to see an increase in supply? Well, the Fed raising interest rates is not going to increase the output of refrigerators or of other appliances and electronics or cars. Right now, the supply of cars is super, super low because there aren't enough materials. There aren't enough computer chips. All of these things are impacting supply. John, can you bottom line this for me? What does this really mean? What this really means, next week, when the federal government raises interest rates, it is going to cost you more to borrow money on your credit cards and on your home equity line of credit, but it's also going to start the process of lowering inflation. Inflation is why mortgage rates have gone up, because mortgages are concerned. Mortgage companies are concerned that if inflation is out of control, we're not really going to make any money in interest because it's all going to get eaten up with inflation. I believe that we're going to see some downward pressure on mortgage rates as the Fed starts raising their interest rate. I just don't know if it's going to happen right away. I think we got a ways to go still because inflation is super, super strong. And the fact is, I think rates are going to keep going up in the medium term. What I mean by medium term is in the next 3 to 6 months, we're going to continue to see rates going up. We're going to continue to see the Federal Reserve raising the short-term interest rate. They're not going to do it just once. They're going to do it a lot of times, and we're going to see that interest rate going up pretty significantly this year. But at some point, that's going to start bringing down inflation, which is going to start bringing down mortgage rates. I hope this all makes perfect sense. I will tell you that the housing market itself is super, super strong. We're seeing a lot of buyers trying to buy very, very few homes. So if you're thinking about buying a home, you need to make sure that you've got the right approval, you've got the right advice, and that you're buying with the right tools. So give me a call. I'd love to help you out with that. Hope you all have a wonderful day, and we'll talk to you soon.